The current live trading price for Tesla stock, NASDAQ TSLA, is $393.40 as of 10:08 a.m. Eastern Time on November 14, 2025, reflecting a significant intraday drop of -2.14% or -$8.59 from yesterday's close of $401.99. The stock has traded in a wide range already this morning, from a low of $382.78 to a high of $398.70, with a volume exceeding 25 million shares in the first hour of trading alone, signaling high volatility and strong downward pressure. This price action, while dramatic on the surface, conceals a deeper, more persistent issue that many retail investors, especially those utilizing self-investing platforms like Robinhood or Fidelity, are missing amidst the noise. The common expectation is that Tesla's valuation, which remains enormous, with a market capitalization around $1.23 trillion, is constantly justified by its future potential in AI, robotics, and energy storage, a narrative that often overrides traditional metrics. The reality, however, is that the market is beginning to assign a discount to the rate of growth, not just the growth itself, as evidenced by the stock's recent re-entry into negative territory for the year, making it an outlier among the Magnificent Seven group. The core tension in Tesla stock right now is between the aspirational, nearly sci-fi future that the company promises and the grinding, highly competitive, and price-sensitive reality of the global automotive and battery markets. The immediate stock movement over the last 48 hours is a microcosm of this tension. The drop follows a broader tech sell-off, but for Tesla, the pain is compounded by specific company and sector headwinds. We've seen a noticeable rotation out of high-multiple growth stocks, and Tesla, trading at a price-to-earnings ratio well over 200, is particularly vulnerable. What's critical here is that this isn't simply a macroeconomic tidal wave. It's being fueled by growing institutional skepticism about demand, particularly in key international markets like China and Europe, and the associated compression of profit margins. The Q3 2025 earnings report, which was released a few weeks ago, already painted a picture of margin pressure, with operating income declining year over year, even as total deliveries hit a record of over 497,000 vehicles. While the delivery number itself exceeded many analysts' consensus figures, the market reacted poorly to the 40% year-over-year decrease in operating income, resulting in a negative 37% drop in GAAP net income. This is the reality check. Spectacular volume doesn't mean much if profitability per unit is eroding due to aggressive pricing actions aimed at staving off competition. For an individual brokerage account user looking at this, it is easy to focus on the headline delivery numbers, but the real story is in the margin contraction. Trading volume is heavily elevated today, suggesting significant block selling from institutional holders, which often drives the initial steep price declines. Recent 13F filings show a mixed institutional picture. Some large funds have increased their positions, notably ARK Investment Management, which often acts as a bullish anchor for the stock, while others, like Kingstone Capital and Valeo Financial, executed significant position reductions in Q3. This divergence shows a classic market divide. The true believers in the long-term, AI-driven thesis are adding at these lower prices, while more fundamentally focused or macro-oriented institutions are taking profits or reducing risk exposure. It's this net institutional outflow, or at least a plateauing of buying conviction at the biggest funds, that is creating a ceiling for Tesla stock in the short term. The stock's failure to hold the 400 psychological level, especially after the recent approval of the massive CEO pay package, a move that was framed as securing the company's leadership for its next growth phase, is a strong technical signal of weakness. The expectation was that securing this package would resolve a key government's overhang and provide a catalyst, but the reality is that the market is currently more concerned about the next quarter's financials than the long-term vision. The technical breakdown has now pushed the stock toward its 52-week low range, suggesting the selling is not just rotational but fundamentally driven, testing support levels that have held firm for months. When we consider the actual business behind the Tesla stock ticker, the core model is straightforward but layered with speculative potential. Tesla is an automotive manufacturer, energy storage provider, and increasingly a software and AI company. The automotive segment, primarily the Model 3 and Model Y, drives the vast majority of revenue. Their competitive edge traditionally lies in superior battery technology, an integrated software stack, and a direct-to-consumer sales model that bypasses the legacy dealership system. The energy segment, with Powerwall and Megapack products, offers high growth potential, especially as grid-scale storage becomes a necessity for renewable energy adoption globally. However, the most significant component of the sky-high valuation is based on the autonomous driving and robotics potential, the robo-taxi network, and the Optimus bot. It is this intellectual property, the potential for a subscription-based, high-margin, fully autonomous driving service that analysts at firms that rate the stock a strong buy often anchor their highest price targets on, sometimes exceeding $600. The expectation here is that the software will be perfected and deployed quickly, turning vehicles into high-margin, income-generating assets. The reality, which is slowing the stock price, is the timeline. The regulatory, safety, and technological hurdles for truly unsupervised autonomy are proving tougher and taking longer than anticipated, pushing out the realization of that high-margin revenue stream. This is where an individual investor using an online investment platform like SoFi Invest or Interactive Brokers needs to look beyond the hype videos and consider the cash flow timing. Past performance, while not indicative of future returns, shows the stock's remarkable volatility, which is precisely why it attracts active traders who may be utilizing platforms like Robinhood stock trading. Over the past 52 weeks, the stock has traded from a low of $214.25 to a high of $488.54. This huge swing is a testament to the market's wildly changing perception of the company's execution against its potential. The dramatic run-up to its 52-week high was largely predicated on a short-lived sentiment boost and the perceived success of the Cybertruck rollout, and a strong prior-year earnings beat. The current downward trend, however, is a classic correction based on the multiple compression theory, where the market decides the underlying cash flows don't support the premium valuation multiple anymore. The recent focus on the affordability of newer Model 3 and Y variants, while good for volume, is a double-edged sword. It's necessary to combat cheaper EVs from competitors like Li Auto and BYD, but it simultaneously cuts into the automotive gross margin, the very metric the market demands to justify the premium. Looking forward, the outlook for Tesla stock is tied to a few major catalysts, and the expectation versus reality dynamic is stark. The expectation for the next 12 to 18 months revolves around a tangible, scalable demonstration of its autonomy technology, which would validate the entire software-as-a-service bull case. Management has promised robo-taxi production to start in April 2026, with expansions in cities like Miami and Dallas. If they can execute on this timeline and, crucially, secure regulatory approval to remove safety drivers in key markets, the stock could see a parabolic move, as that is the moment the high-margin revenue potential becomes real. The major reality check for the future comes from the capital expenditure requirements. Tesla's ability to successfully roll out next-generation vehicles and cybercab technology will depend on continued heavy investment in new gigafactories and production tooling. While the company has a massive cash balance, over $41 billion in cash and investments as of Q3 2025, this capital needs to be deployed effectively and efficiently. Meanwhile, legacy automakers are finally scaling up their own EV programs, and while they may not have Tesla's software edge, they are closing the gap on battery tech and have decades of manufacturing experience. Furthermore, companies offering online investment help, such as those promoting Schwab Intelligent Portfolios or Fidelity Wealth Management, are increasingly cautious about allocating massive weights to a single volatile name like Tesla in broadly diversified portfolios due to the inherent concentration risk. Key risks for the Tesla stock trajectory are highly concentrated. The first is key person risk. Despite the approved pay package, any significant distraction or change in leadership for the company would be seen as devastating to the valuation, which is heavily reliant on the singular vision of its CEO. The second is execution risk in manufacturing. Achieving production targets for the Cybertruck and the upcoming robotaxi Cybercab platform is far from guaranteed and has historically been a stumbling block. The third, and perhaps most immediate risk, is the continued pressure on pricing and margins. If global EV demand softens further, or if foreign competitors continue to undercut their prices, Tesla will face a difficult choice between sacrificing volume to protect margins or cutting prices further to maintain market share, which will only exacerbate